Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Alan, great to be back with you this week. How are you doing? How is Dublin treating you today?
I'm very well, thanks. Looking forward to our conversation. All good here, and looking forward to catching up in person soon as well.
I know, Miami next week. It's going to be fun. And Kate?
Big week in our industry, yes.
Big week in our industry, and Katie will be there as well. So I think the three of us at least, hopefully some of our loyal listeners will find us and we can have a chat and maybe a coffee. All right. Well, I mean, we have some good topics, as I always say, because I do think generally they are good. We also have a question, which was good, sent to us. But before we get into all of this, I'm always curious to know what's kind of, besides all the topics, what's been on your radar? What have you paid attention to recently?
Yeah, it's interesting. It's been a while since I've been on here by myself. Obviously, we had the group conversation in December, but certainly, it seems like quite a different market from a sentiment-wise. This year we're already off to a very positive start, and equities, after a little bit of a dip, pushing higher, and with all the talk about Fed rate cuts and soft landings, part of me, having been very cautious on the equity market now, is wondering, is there going to be some kind of blow-off, kind of melt-up or something? Everybody seems to be so bullish. So just very interesting from that perspective, how sentiment has changed so much in the last while. So that's one thing I've just been tracking as well. I mean, part of that argument is around a lot of money in money market funds. So just curious, is there a lot of money either sitting on the sidelines or having gone into cash with the high short-term interest rates in the last year that might now come into the market, and will that go to equities or bonds, or where would it go? So that's a second theme that I think is interesting. And a third thing that I just came across recently was just an article there around CalSTRS increasing their facility to take leverage into portfolio. So this seems like more of an operational adjustment. They've always had an element of leverage in the portfolio, but they are now increasing that. But maybe it does point to some issues. I'm not sure if issues is too strong word, around their less liquid portfolio, if they feel that they have to increase their cash facility. So perhaps they're starting to see some of, or maybe they've over-allocated to the less liquid side of the portfolio. But interesting, I mean, that's a general trend that we're seeing of some of these larger institutions and pension funds increasingly, using leverage, and both from a portfolio perspective and from a kind of a more operational perspective.
Yeah, I mean, I did notice the article because you sent it to me. And I mean, for those who haven't read the article, what it's all about is that they would like to be able to borrow up to 10%, which is $30 billion, so that they, as it says, don't have to sell out at assets at distressed levels. Now, when you describe it, it sounds, oh yeah, that's not a bad idea, that's fine. But what if these distressed assets become even more distressed? I mean, I'm thinking at some point there must be a stop loss somewhere. Is it a facility that would encourage people to be, how should I say, a little bit too optimistic about the future and not really realizing that what they're invested in is crap and they need to get out? So pardon my French, by the way. Yeah, so I think that's one thing that's a little bit worrying. And of course, being the second largest pension fund in the US, if they go ahead and do this might, of course, start a trend with other pensions. And then suddenly you have lots of pensions not having or not wanting to realize bad investments. And so I think it creates some kind of I don't know what the word is, but it makes it a little bit artificial that you don't have to recognize losses, and we all know how these things can go pear-shaped if you start not recognizing losses. So I don't think it's a great thing, but I do understand why they want it. But yeah, I mean these kind of private investments that are so popular, private equity, now it's private credit. I mean, I guess from the trend following world we come from, I mean, we love liquidity. We love the fact that we can liquidate our portfolios in 24 hours. And that's just a different world. And I think in an uncertain world, which we'll come to, I guess, in our global macro conversation, liquidity is important.
Yeah, I mean, I think it's about having a balance. I mean, there's just been a huge wave of money into private assets in the last decade, and the case for it is well made, and obviously in private credit, from the data I have seen on some managers' performance was good last year. But of course, all of these strategies do well in the same environment. If in the same regime when it's a favorable, they don't do well in the negative tail event, but they all do well in the rest of the time. So it's kind of understandable why people have them. Probably equally understandable why tactically it may make sense to have more leverage from time to time or the facility to borrow. But as you say, maybe it has to be in the right hands and appropriately governed and overseen, I guess.
Sure, of course. By the way, I mentioned it's the second largest U.S. pension fund. They have done 7.2% annualized in the last 5 years. And in their 22-23 year, they posted a 6.3 net return if someone was interested. All right, well, good to know what's been on your radar. Let's look at the other big thing that we always talk about, and that's kind of your big macro picture. I'm in a world that seems to change a lot every time or in between we speak. I'm curious to know what your thoughts are at the moment.
Yeah, I mean, I think the big thing everybody is looking at and thinking about is this Fed pivot that's underway. We had Chair Powell speaking in December, and I think, fair to say, it really surprised people in how dovish that the Fed had turned so quickly. And there's a lot of speculation as to why that was the case. Was it politics? Were they kind of positioning ahead of the election this year? And are they planning on getting rates down early in the year to avoid kind of any conflict with the election, or maybe even to boost Biden's prospects, who might seem to be a bit more pro-Fed independence or less likely to meddle with their own independence. So kind of conspiracy theories around that, I guess. And also, obviously, the inflation data has been on a downward trend. We have to acknowledge that. And if you look at the kind of the PCE, the 6-month annualized, it's down at or below target. So there certainly has been progress on inflation. I thought what we got this month with the speech from Waller was quite interesting. He kind of gives more context to what I think is the overall Fed thinking. And when I read it, I felt it was a little bit self-congratulatory in a sense. He was kind of talking about how 2 years ago he made a speech about how we might be able to. The Fed would be able to raise rates and bring down inflation, and you wouldn't see a rise in the unemployment rate, or a significant rise. And that's what we've seen. And it's an example of great analysis and great data and great work all around. So I thought it was maybe a little bit premature for him to be prepared or, declaring victory and giving themselves a pat on the back. But that's certainly what it felt like. And it's interesting because if you read what he's saying, it's very much the case. He's saying the Fed took rates to a level that was restrictive enough to take the slack out of the labour market. And that slack has been unwound purely in terms of the vacancies, as opposed to, we haven't seen a rise in unemployment. So the labour market's been very tight. You've had these unusually high job openings, if you see that in the Jones data. So vacancies have been very high, and that's where the tightness has been seen. And they're saying they're able to tighten policies so much just to take the tightness out in that area without starting to see a rise in layoffs and an increase in unemployment. And then they'll be able to pivot and reduce rates to keep the economy at that level. So when you think about it, it's very much this kind of, it's very much a labour market centric view of the world. and of the inflation process, which we know has failed in the last couple of years. You only have to go back to 2021 where the Fed was saying, well, we'll start to raise interest rates, when unemployment stays low for a long time. And then subsequently you'd expect inflation to rise. But obviously inflation just jumped up in the first place without that, without the unemployment rate staying very low for a long time. And now we're seeing the opposite of inflation coming down unrelated to kind of labour market developments. So it does question if their whole model is correct around inflation. But also this whole idea of being able to pick the exact level of interest rates and the economy responding mechanically to it, it's just totally opposite of the view of, the economy as a complex adaptive system, that we always like to talk about. And we heard so clearly from Bill White that time. So it makes me worried that the Fed will get overconfident because it seems to have been successful in what they've done so far. But we all know that it's an almost impossible task to try and calibrate policy perfectly. So we'll see. I mean, I do think the case he lays out looks reasonable, for lowering rates now because obviously policy is tight. But I think it's foolish is maybe too strong. But to think you can fine tune policy so finely, I think we'll find in time that will prove difficult to do.
Yeah, I agree with you completely. I think it does seem like a little bit too over-optimistic about their ability to control everything. He does, towards the end of the speech, and I quote, say, as long as inflation doesn't rebound and stay elevated, I believe FOMC will be able to lower the target range for the federal funds rate this year. The view is consistent with the FOMC's economic predictions in December, in which the median prediction was 325 basis points cuts in 2024. Of course, the market didn't read that very carefully. They thought 3 meant 6, so they went straight on to go for that. But anyways, we'll see. I think when we had our group conversations, we all made some outrageous predictions, which will make it a bit of a challenge, I think, for the Fed to keep up. Now, before we leave this topic completely, because we're talking about global macro issues, I couldn't help wanting to ask you a thing. I mean, this is not a political podcast, of course, but when it comes to politics, we have to admit that they do have an impact on the world economy and financial markets. And we did have a primary election in the US this week that kind of suggests that Trump may be facing off with Biden again later this year. Even if I actually, in my outrageous predictions, predicted that none of them will be on the ballot in November. So we still have to wait and see about that. But how do you think markets and economies may be impacted should Trump win back the White House?
Yeah, it's a great question. And in some of the conversations I've been having on the Allocator and macro series, I've been asking that question. They may not all have been out published yet, but certainly on my radar. Very hard to say. It says, but not providing anything blindingly insightful here, except to say that, the question I would have is that a lot of what we've seen in the last number of years has been, related to Bidenomics and, the nearshoring, the Inflation Reduction Act, all of that focused on developing kind of more manufacturing back in the US. Now, you would say that's kind of consistent with a Make America Great Again type platform. So should we see any dramatic change from Trump? That said, I understand from some commentators that he's not a fan of the Inflation Reduction Act. Certainly, we would expect to see more protectionism. He has said before that there would be a 10% tariff on all goods coming into the US straight away. So obviously, that would be inflationary in the first instance. We did see, protectionism in his first term, so I think that would be a very reasonable assumption. I think you're going to see tensions around a number of areas. One, obviously protectionism. Two, he's also said that he's going to go after his political opponents pretty much straight away once he comes into office. So, where does that play out? He was kind of less maybe briefed as to how he could wield his power when he came in the first time, but now he knows what he can and can't do. So that's the second area. I think with respect to the Fed, that's a third area, and I think that there is a valid reason for why the Fed might be biased towards Biden, because he did meddle a little bit in the last term, but not to a massive extent. And he certainly was making comments like, they've got lower rates overseas, why can't we have that as well? So I would certainly expect to see a lot more political, interference in monetary policy, either directly or indirectly. And then the fourth area I would say is around debt and deficits. Donald Trump doesn't strike me as the kind of person who's going to say, let's get our house in order, even if it's, politically, unpopular. He's a populist politician. So, the last time he was in, he was already running a large deficit when the economy was doing strongly, and then that carried on into COVID and carried on with Bidenomics. So you'd have to say prospects for fiscal conservatism would be low. Obviously, a lot depends on who's in the House, who has the Senate, but we've seen Trump use executive orders. So I'd be pessimistic on debt and deficit improvements, and you'd have to be pessimistic on protectionism. That said, when he got in last time, the day of the election in 2016, equities went down and then rallied pretty hard for a couple of years. So how do markets take it? I don't know, but certainly they would be the themes I would be focused on in terms of the agenda and how we might influence the economy and markets.
Yeah, no, I think that's a good checklist. Now, since that was a super easy question for you, Alan, I'm going to add another super easy question for you. And that is, what about, since we are in the global macro world now, what about China? They've kind of gone from this international growth engine to a domestic disaster. Do you follow this? Do you have any thoughts?
Yeah.
Or some of the guests you've had, any thoughts?
Yeah, some of the people I talk to and some of the managers speak to on the macro side, I think, what we're seeing obviously this week is an intensification of the concerns around the property side, about the debt deflation, etc. And we have seen a policy response in the last couple of days in terms of a 50 basis points cut in the bank reserve requirements. Hang Seng, some of the Chinese stocks have rebounded in the last couple of days. I think the big picture here is, what's the policy response ultimately? What should it be and what will it be? And China is somewhat constrained. When we've seen this kind of challenge in the West, say post the global financial crisis, the policy response was bring rates to zero and quantitative easing. So in an essence, that would be an obvious policy response in China. Flood the market with liquidity that would boost asset prices and should reverse the deflationary trend and could help the property market. But they seem to be reluctant to do that because they're worried about, a significant weakening in the renminbi. So it's this classic kind of dilemma or trilemma that you can't control all of the different levers of policy. If you want to control the exchange rate, then you're giving up control of monetary policy. So, they did allow some weakness in the renminbi last year, but they seem to have stabilized it for now, and they don't seem to be on a path towards, money printing or QE. What they do seem to be doing is making a grab on global manufacturing. So, what we're starting to see, particularly in EVs, we're starting to see here in Ireland, I'm hearing BYD being advertised on the radio all the time. And, we're seeing the European Union becoming very concerned about the threat. Volkswagen under serious pressure in Europe, the threat of EVs. So, and even speaking to people who allocate to China and Chinese equities, making a point that China may not even benefit. These companies may not develop or benefit so much because they'll cut their margins just to grab global market share, but it will be a significant competitive threat, and that would also contribute to that kind of general trend towards protectionism that we may see. So I think that's the direction that they've gone so far. It's to try and boost manufacturing in certain sectors like batteries and EVs, etc. We'll see how that plays out, and we'll see what's the response. The implication is if they're going to have a bigger share of global manufacturing, somebody else has to have a smaller share. So that's Europe and the US, and Europe and the US won't want to have a smaller share. So how does that play out? So it seems to be their move in terms of policy for the moment, but is that sustainable over time? Probably not. and how does it play out? And that is in the short term probably a little bit of a disinflationary force at the margin. So we'll see how that plays out. But whether that's going to be significant enough of a policy to see China starting to come out of this slump, I don't think so. But we'll have to see.
You gave me a little bit of a cryptic topic for kind of this global macro segment, which I don't know whether you feel you already mentioned or not, but you wrote money market funds. Did you have any thoughts that you wanted to share on money market funds?
Well, that was just where I'm saying the amount of cash we're seeing on the sidelines. And we have seen, I was just looking at the data, there's $6 trillion in US money market funds, which is up about $1 trillion in the last kind of 12 to 18 months. And if you look at bank time deposits, they're up about 600 billion in the last year or so. And that's where I would expect you probably would see anybody who's going to kind of go into a bank account to try and take advantage of a higher yield would go into a time deposit. So, if we start moving into this lower, well, not a low rate, but start moving into a rate cutting environment, will that be the trigger for investors to, start to move back into the markets? And is that going to be a boost? But is it for equities and is it from or fixed income? Certainly for people, in the more mainstream asset management industry, a couple of people I've been talking to were saying like last year was a tough year asset raising because of this phenomenon. That a lot of people just said, well, why don't I just take the 5.5% in dollars or 4.5% in euros and not invest in anything, whether it was trend following equities or bonds. So will we see all of that reverse? So yeah, I think it's going to be interesting.
All I can say is, when has asset raising ever been an easy job? I speak from some experience. Let's put it like that. Anyways, all right, let's move on to the trend following update. We were off to a kind of a soft start for CTAs and trend followers in the first 10 days or so of 2024. Since then, we've actually had quite a nice recovery in performance. All the indices that that we track here have turned positive for the year. Although the last couple of days, again, we see a little bit of softness, but I think still overall in the black. Best sectors, according to my trend barometer, when I look at that, are softs and stocks. Now, that doesn't always tie in completely with what managers will see, because timeframes will be different from how I calculate things. But actually, when I look at sort of the managers that I have access to following more closely, it looks kind of right at the moment. Within soft, we have things like Cocoa doing pretty well. Within equities, obviously Japan has been on fire. And then at the same time, actually, Hang Seng has had a really sort of continuing its weakness to some extent. And that's actually also worked out for trend followers on the short side. Now, one of the sectors that I thought could be dividing performance amongst managers this month would be things like fixed income, where I think faster models probably would have gone long towards the end of last year, whilst longer term models potentially are still a little bit short. And therefore, because of bonds being off in January, that can make a little bit of a difference. But that's kind of how I see it. Alan, feel free to add anything if you have any. No,
that'd be my thought. I mean, I think we saw that with a little bit of dispersion in December as well, but those faster models would have benefited then, and they're giving a bit back, and similar kind of pattern with respect to the US dollar as well, to a lesser extent.
Yeah. My own trend barometer finished yesterday at 25, so that's still pretty weak, although it did recover some from the exceptionally low readings below 20 that we saw earlier in the month. As of Wednesday, because we're recording on a Thursday, Beta 50 is up 1.17 for the month and therefore the year. SocGen CTA index up about 95 basis points. SocGen trend up about 82 basis points. And the short-term traders index is up about 19 basis points. That compared to traditionals, where MSCI World is up about 1.08% for the month. World Government Bond Index is down 1.5%, and the S&P 500 is up about 2%. All right, with that, let's move on to the question, which is actually two questions. And it is from Cyprus. Now, the listener did tell me who he is, so that's fine, but he didn't want his name to be on air, so that's perfectly fine. First of all, he writes, firstly, thank you for a great show. A lot of thought-provoking and educational material here. I've been part of the managed futures trend-following systematic industry for a decade or so, now taking a much slower pace with it, semi-retired. I fell into it by chance, as I met an American gentleman who had retired to Cyprus, who was well and truly part of the industry, having passed through Commodities Corporation and managed futures and managed his own CTA for over 25 years. Once I understood the concept, I was completely converted from my traditional CFA past, and I have been a keen follower of all things systematic. I know there's a lot of discussion over the terminology of the various flavors, and I apologize for using them interchangeably. I have been working with him since on our own trading and thoroughly enjoying the ride. Okay, I have two questions. I was speaking with a high net worth friend who has been overly reliant on private banking solutions, of which I'm not a fan, and as a result has realized the limitations of the 60/40 portfolio the hard way. I have taken some time to go through the concept and the value added of managed futures and CTA and trend. The question he has is, what would be a fair allocation to such strategies in a diversified multi-asset portfolio?
Yeah, it's a good.
And who better to ask that question than
absolutely
a previous allocator?
That's right. No, for sure. I mean, this is a particular bugbear of mine. I mean, if you look at most multi-asset funds, I would say, or if you look at the multi-asset allocations of a lot of private bank offerings, okay, they're not quite the 60/40, but they're very much a derivative of it. It tends to be like 50 to 60% equities, maybe 20% bonds. There could be some private markets within both the equity and the bond allocation, maybe 10% credit, and very often something like, 5 to 10% in hedge funds. But very often then that would be also including hedge funds that are not necessarily particularly diversifying. They could be market neutral or long short equity or even credit type strategies. So then you get into a much smaller sleeve where you're getting allocations to directional strategies like trend and or managed futures or macro. And why is that? Like, one of the reasons for that is very often the people running these portfolios come from either an equity background or a fixed income background, and they're not as familiar with trading strategies as we are in our industry. And also they tend to then suffer from some common misperceptions. They might say, like, okay, let's go in within the alt sector, let's find the highest Sharpe ratio strategies and we'll allocate to those. Or they might say, well, let's find these strategies with a really good risk-adjusted return performance, but they might be really low vol and it's not going to do a whole lot for the portfolio. So that's a long-winded kind of intro to getting to the answer, which is it depends. And I think you have to always balance kind of the right answer from a pure portfolio allocation perspective, which would tend to point to a higher allocation to trend and diversifying strategies, and balance that with the behavioral element of, will the client be able to hold that and be confident enough in holding that through the cycle? Because obviously you don't want to allocate to too much and then clients say, well, I don't really understand it as the first time you get into a drawdown. I mean, to give a sense on the range of kind of allocations, the typical answer is kind of 5 to 10%. But I would have said, if you think about asset allocation and split the assets between what I would call growth assets, diversifying assets, and then tactical trading strategies, and managed futures, macro would be in the latter category. I would say it could be, you could reasonably be 40. Could be 40-20-40, 40-30-30, or 40-40-20, but it's a number of the order of kind of 20%, and that's 20% of portfolio risk. So an important point I would say to be conscious of is to think about the risk allocation that you've got to the strategy, and not just the notional allocation, because one of the big downsides and problems with the 60/40 and with all of these types of portfolios is they're dominated by equity risk, and that's fine if that's what you want, but you're kind of positioning this as multi-asset, which kind of gives the connotation of that the returns are going to be influenced by lots of different assets. But because equity vol is 16% and bond vol, depending on your duration, might only be 6 or 7, you're getting a lot more risk in equities. So when you start looking at the diversifying sleeve, okay, you could have 40% in there, but if it's at 5 vol, that's not going to move the needle a lot. So think about the risk contribution, and I would say, 15 to 20% of portfolio risk in these types of strategies would be meaningful in terms of moving the needle, and it could be higher or lower depending on the client and their appetite and their understanding of the strategies. But it's not like 5% in notional terms. That's just at the margin.
Yeah, no, I like that answer. Obviously, I'm probably a little bit to the higher side of that. And the reason I say that is partly I update on our side a little fun experiment every month. And the experiments we thought, because we get these questions a lot, is to say, well, we can obviously say what we think is kind of a good average allocation if you have stocks, bonds, and managed futures. But what if timing was an issue? Meaning, what if you really timed it right or wrong? So the way we thought about that was to say, well, why don't we just say what's the optimal allocation? And in this case, we're just basing it on the higher sharp of the portfolio. If you started just before a crisis or if you started right after a crisis. So we just say, okay, before the tech bubble or after the tech bubble or before the great financial crisis or after the great financial crisis, just to see some extreme starting points. And in that case, and I don't recall the number specifically, but certainly before and after the tech crisis, the allocation, and of course we're using our own WMA strategy as a proxy for trend following, but you do get quite a high allocation to it. But I think it's like 16 to 18% allocation before and after, meaning it's incredibly consistent. So the trend following part hardly changes. What changes is the allocation you should have had to stocks and bonds. Then when you look at the great financial crisis from 07-ish and 09 as starting points, you actually get a higher allocation to our strategy, but that's because you get zero allocation to bonds, really. But you do still get quite a big change between stocks and bonds, because initially you should have had some bonds, I think, and then after 09 you should have had no bonds. So anyways, I think the point I'm trying to say is that I don't think 25% is a bad number, but I would also argue I think that allocation is the more consistent of the three assets in a simple multi-asset between stocks, bonds, and managed futures.
The other thing I would say is, I'm saying that 20% in the context of the information that's been given for kind of a multi-asset. I do work with some investors who will go 50% growth strategies or growth assets, 50% diversifying strategies, and they're comfortable with that. So it's not one number that fits for everybody. It's you have to take into account the behavioral element, as I say.
Yeah, no, absolutely. Then our listener has one more question, follow-up. He says, given the straitjacket of the EU regulation, what are the better options to gain exposure? Man, Winton, Dunne Capital all have UCITS, but do you have any good resource or insights to help the selection process? I have one suggestion, Alan, but you may come across this more. Are there any public places where you can go and have a look at some of these funds nowadays?
In terms of like a fund supermarket, that type of thing, or what do you mean?
Well, okay, so I'll give you my resource. So what I was thinking of, and I don't know if you have to register. I think you have to register, but I have a feeling that these gentlemen will, even if it was for accredited investors, they would be fine. But my source would be the Kepler database, which I think lists all the UCITS funds. Now, again, I would say if you don't have to be restrained by UCITS, I think the offshore vehicles of these managers will be cheaper. You may have monthly liquidity instead of daily liquidity, but you shouldn't really worry about that if you have a long-term investment horizon. But yeah, I would say that database is one that I would say probably gives very good overview of UCITS funds for sure.
No, that's right. It is a good comprehensive list and has some analysis, and obviously they have their own platform with certain managers as well. So I think that's certainly the case. I mean, you can get the UCITS performance data on lots of platforms now, the FT as well. I mean, I think in terms of the question around any insights as to how to make the allocation decision, I think within the UCITS space, there's obviously there's the general issues around how to make the decisions to allocating in this space, which we kind of know about in terms of, multi-manager or not, or allocating to a few managers, or trend only, or diversified. So they're all the typical things. But also, when we're working with investors, we're highlighting that often in the kind of this space, investors don't have a facility to do a managed account, so it's a fund only. So when you think about it, you really got to be conscious of the level of volatility again. So I'd emphasize that, because obviously, if you can allocate through managed accounts, the manager's vol doesn't really matter, because you can lever it up or down to whatever vol you want. But when you're constrained to allocate in funds, you get more bang for your buck if you go with the higher vol offering. So that's certainly one important thing to think about. Obviously, the fees and particularly with UCITS, the fees are generally a bit higher than the offshore vehicle. And then obviously, are you getting the commodity exposure or not? So we've got different approaches. Some managers took out commodities because there were issues around that in Europe, but increasingly managers are now, accessing commodities either via swaps or certificates, but basically overcoming that challenge. So it's certainly, as a general rule, you're better off having the commodities in there. So they would be the kind of the things to think about. It is difficult to get access as a private investor in Europe. It's not like the US, where you can just buy a lot of different strategies through the brokerage account. You have to go through either direct to the manager or through a wealth manager. But yeah, I mean, it's kind of a matter of going through the due diligence process as you would with other strategies, but just through the lens of the particulars of UCITS.
One thing I would just add, given the fact that I work with UCITS every day, is just to be aware of that there are some funds where you can actually buy them directly. You may have to have the subscription document sent via your financial advisor, but where you can buy them directly, and therefore you don't pay any extra fees to custodians or banks or whatever. Because I do get a feeling that if you ask your bank to do it or a platform, they're going to charge you something for doing it, but you don't, in many cases, don't really need them. But anyways.
There are a couple. Yeah, I know in Interactive Brokers, you can invest directly in a small number, but it's not very large. And there are a couple of other platforms in the UK, like AJ Bell and some of these. But it's not, as I say, the industry hasn't evolved to be like the US mutual fund market by any means.
All right. Let's move on to actually the topics of the day. One is the first one actually is still within the kind of the playground of managed futures, because I sent you a question yesterday, and the question was inspired by the fact that because many equity indices have recently come out of a drawdown, lots of people were posting charts about how long in days had the recent drawdown been, and how long do equity drawdowns typically last? And I didn't have myself any particular stats on what about managed futures, trend followers, what about drawdown length? We talk about drawdown depth, but we don't always talk about drawdown length. My hunch is that they're certainly shorter than equity drawdowns on average, but I don't have the numbers, but I know you may do. So I'm excited to hear what you found. Well, noticed.
Brace yourself. I don't think the numbers are that exciting. I mean, I only did a very cursory analysis last night, this morning. But I mean, to give context, as you say, the SocGen trend, and I've only looked at it since 2000 and based off monthly data, so it's not as minute as it could be. Generally, in terms of magnitude, certainly equity drawdowns are much bigger in terms of the magnitude. If you think about over the last 20, 24 years, you had, 07, 09, that was about 51%, 2000, 2002, about 44%. You had another drawdown during COVID, 24% or so, another drawdown last year, 2022. So we've seen, whereas the largest drawdowns for the SocGen Trend Index are of the order of kind of the top 5 of order of 15 to 20%. So much bigger drawdowns in terms of the magnitude. In terms of the duration over that period, actually pretty similar. Both the longest drawdown in both cases was I think 72, 73 months. So 6 years, which surprised me because when the largest drawdown for trend following did rumble on quite, in that period from 2015 to 2021. Now some of the managers got out of drawdowns through that period before the index did. So that's why I had to kind of go and check that again, because there was a couple of upswings in performance for trend following. But for the index as a whole, it did go on that long. The other interesting thing is when you look at it, the SocGen Trend Index is in drawdown 85% of the time in that period, which is not surprising. We always say trend following is always in drawdown, or the majority of the time, whereas the S&P was in drawdown 73% of the time, which is probably higher than if you took a long-term perspective going back before 2000. I would say that number would be a little bit lower because obviously we had two big equity drawdowns in the 2000s. And in terms of the number of drawdowns, we've had 28 for the S&P and 23 for the SocGen Trend in that period overall. So, I mean, what do you make of all of that? I didn't come up with it didn't make me feel any more or less inclined to invest in either equities or the SocGen Trend. I know you do see some analysis around the SocGen Trends in a drawdown of whatever. So now's a good time to invest.
Well, of course, what we should have done, Alan, is to say, okay, that's fine. But what happens if you do 50-50 of those two? What happened to the length of drawdown? I think that's where the magic happens, at least. But the other thing is, I seem to remember that I once saw an article of someone saying, well, did you realize that the Amazon stock that has gone up, I don't know how many thousands % in the last 25 years, actually is below an all-time high, like 95% of the time. So it's so drawdowns is a funny thing. It really is.
No, I agree with you. I mean, that was one of the points. Like, is drawdown the right measure, the right thing to focus on? And even when we had that drawdown in trend following, in that long one, my recollection of it, maybe it wasn't even as painful as the one that was before that, the 2011 to 2014, which seemed to be more a painful one for investors. That's just my own perspective. But, I certainly think it's not just drawdown. It's like what's going on in other asset classes, how the rest of the portfolio is doing. Are you seeing any, you can still have positive years within the drawdown. So I think as long as people are seeing, progress in the right direction, drawdown isn't necessarily the be all and end all. But it is certainly in it. One relevant set.
Well, you and I talked to a manager last year, and people have to go and check out and guess who it might be. But we talked to one of the manager last year in our CTA series, and I think they had been in a drawdown for more than 10 years, actually. So I'm not going to say the name; people can do their homework. But but I think this is once you go to those extremes, I mean, that's going to hurt business, right? But yeah, I mean, all strategies comes with drawdowns, and of course, some of them can be dragged out a bit. Doesn't mean that they're severe, and it's just kind of more boring than anything else. Good. All right, let's move on to something that is not related to managed futures, as far as I can tell. A paper that you sent over to me, which I don't think I had time to glance through it because you sent a few papers. But this one, I thought, I'm going to leave that with Alan. And so tell me about this one and why you wanted to talk about it. It's a paper called Stocks for the Long Run - Really.
Yeah. Well, actually, it's called, I think that might have been the title I put on it. It's called Stocks for the Long Run. Sometimes yes, sometimes no. It's by a guy called Edward McQuarrie, who's a professor at Santa Clara University in California. I saw this paper being referenced before Christmas, and I didn't have a chance to read it at the time, so it's on my mind to go back and have a look at it. And it's really it's a reassessment of what the long-term evidence on equity performance and the equity risk premium is. And the title Stocks for the Long Run is obviously a hat tip to Jeremy Siegel, who's wrote the book that I have here beside me. It's, and it's really, it was the piece of research, piece of work that really formalized that, from a data and a research perspective, the case for having equities at the core of portfolios. It really put the data in a very clear place that showed the long-term outperformance of equities. And it showed not just kind of a long-term outperformance of equities over fixed income and cash, but also that there seemed to be a fairly stable long-term real equity return over kind of 3 long-term periods. Like he showed that the real return on equities in the US was about 6.5%, 7% over 3 distinct, I can't remember, maybe 70-year periods. And also it showed that your kind of risk of holding equities went down the longer the holding period. The volatility of outcomes declined. And also the likelihood that you would outperform fixed income increased the longer the holding period. So that's why it very much became a no-brainer, stocks for the long run. Well, Edward Macquarie has reassessed that, and his paper is about the fact that you've got new data available, particularly for the 19th century. Now, some people might immediately switch off and say, well, who cares about the 19th century? But bear with me for a moment. And it goes back and it says there was some not flaws, but some shortcomings in the data that Jeremy Siegel used back in the 19th century, and that there's a broader data set available now. More stocks, more data on more bonds in the US, stocks that traded outside the US. And he gives the example of a stock, the Second Bank of the United States, which wasn't included in the original analysis somehow. It was the largest stock in the US before the panic of 1837. It accounted for 30% of the market cap. So kind of like the Magnificent Seven all in one. And that stock went from $120 to $150 during this panic of 1837. So, it does sound like some fairly meaningful emissions, you'd have to say, in the old data. Anyway, so when he looks at the long-term performance again, he splits the kind of data up into 3 periods: 1790 to 1940, 1940 to 1981, and 1981 onwards. And basically what he says was, unlike the Siegel paper, which would have said there's that kind of 7% real return from equities and a fairly consistent equity risk premium, that consistency is now not there when you look at the data again. He does say that in the period 1940 to 1981, certainly equities outperformed quite a bit relative to bonds. Now, obviously, the starting point for yields was very low. That was post-World War II, and the Fed had been basically enacting yield curve control. So bond yields were unusually low in 1940, not as low as we saw in 2020, but they were low. So, and then obviously the end of that period is, 1981, when yields got up to 18%. So definitely a period where bond yields go from 2% to 18% is going to be very tough. But it was a good period for equities as well. Whereas now the way he describes it, since 1981, they've been pretty even, about the same. Now, I was a bit dubious on that assertion. I'm not sure if that's quite correct. They were pretty close up to around 2009, but certainly I would have said equities have powered ahead since then. But anyway, notwithstanding that. And then if you go back to the 1792 to the 1941 period, actually bonds did better. So, I mean, what to make of this, if anything? Firstly, I would say about the 1800s. Obviously, it's gone back a long time, so people might say, that's just too long ago to be very relevant. I mean, it is actually interesting if you look at the long-term economic history of the US and the world. There's an economist, Robert Gordon, who has written about this. And basically, economic growth accelerated from 1870 onwards. It was after the US Civil War. And this century, 1870 to 1970, there was a boom in innovation, in productivity, of the likes of which we've never seen ever. And Robert Gordon, in his book, he points to another economist. He says between AD1, so basically, time of Christ, whatever, since then to 1820, economic growth grew by 0.06% per annum. So that's like 6% per century. So that's like, basically, he said nothing happened for 18 centuries, and then growth took off. So that would be one reason to explain why equities were more challenged in the 19th century. Economic growth wasn't as strong back then. We did have some periodic periods of deflation. You had the US Civil War as well. So it does make sense that would have been a more challenging period. Does that mean anything for investors now? Well, for sure, you could still have a civil war. You can't, couldn't rule that out. You could still have deflation again. So it's not totally irrelevant, I would say. The second thing that he does was in the Siegel book, he says Siegel also looked at rolling returns, not just taking these 3 distinct periods, but taking rolling 10-year, 20-year, 50-year. And in Siegel's analysis, there was a kind of I think you said like a 3 in 5 chance that stocks would outperform. But if you held them for 30 years, it was a 9 in 10 chance that stocks would outperform bonds. So again, very compelling, makes it kind of a no-brainer to be long stocks if you're a long-term investor, almost to the exclusion of anything else. But when Edward Macquarie reruns the data, he doesn't find that that those rolling periods as strong. Certainly not up to kind of 2 in 3 or 9 in 10 or whatever it was. So that is one thing. And the second thing he does is he points to the international evidence, and the international evidence is much less supportive about this very strong equity risk premium. And he points to, I'd have to pull up the numbers there, but he points to kind of 20, 30-year periods across lots of different markets. For example, like the lowest equity risk premium observed internationally over 20, 30, and 50 years. So like there was a minus 2% over 20 years in Australia. So stocks underperformed bonds by 2% for the 20 years ending in 2008. So, we're not talking about 1800s anymore. We're talking about recent past. Or in Italy, stocks underperformed by 5% per annum for the 20 years to 1979. We obviously all know about Japan. We know about kind of, Germany in the war, all of that. But the point here is that he's saying is that this perception that it's kind of an unwritten rule, a law of the markets, that there's an equity risk premium of about 4% for stocks is not there if you go back long enough and if you assess it far enough in the world, which is I think is a fair point and very interesting. The final part of his paper, which I felt was really interesting too, and which is kind of relevant in our world and from an asset allocation perspective. And he says what's important is you can't just say there's an equity risk premium of 4% or whatever. He says it's very much regime dependent. And we are in a regime at the moment which is favorable for equities, but the regime that was and the 1940 to 1980 period was very much favorable for equities vis-a-vis bonds, but the 1800s were not. And so he said what he makes the point, which I think is a good one. Like we naturally think about looking at more and more data to give a better sense of the sample, that this is a larger sample of history. And he's saying that's maybe not the right way to look at it, because if you mix two different regimes, you're kind of getting an average, but that's not that informative. So if you take the perspective of, say, correlation, for example, and he shows the kind of the 20-year correlations between bonds and equities, they were as high as plus 0.9 back in the 1800s, and then went to, I think, negative 0.9 in the more recent regime. So and equally, if you're mixing kind of a very high equity risk premium with a very low one, and you're saying the average is 4 or whatever, that maybe that's not as conducive or as helpful as to say, well, in a favorable regime, it will be this, X, but in an unfavorable regime, it might be Y. That gives you much more information as an allocator. So his kind of message is, once you accept the premise that stocks can disappoint, this all equity portfolio is less of a no-brainer. It's interesting because the other people who've done a lot of work on this are Elroy, Dimson and Ibbotson, and they wrote this long-term study of 100 years of asset class returns, and they call it the triumph of the optimists, which I think is a good way of putting it, because if you're going all in on equities, you are taking that optimistic view. Yes, most of the time you will be right, but that's not to say it's a rule that you're guaranteed over the next 30 years if you hold that you're going to do very well. It could be a favorable regime, it might not be. So I think that the whole thought around what's the outlook for the regime is very important. And I think from that perspective, that this idea of being equity heavy and equity centric, even the concept of when people talk about expected returns, the expected returns on equities is 8, the expected returns on bonds is 4. So then you say, well, why would you ever invest in bonds? Because your expected returns is 8. You know what I mean? It doesn't make any sense, But that's a statistical term, that's just saying that the mean historically is 8, but it might be misconstrued as something else. Whereas it might be more helpful to say to somebody, well, in a favorable regime, it could be 10. In an unfavorable regime, it might be 0 over the next 20 years. And make up your own mind as to how much of an optimist you feel like, and that will determine your asset allocation. But I do think it helps the frame the discussion around adding diversifying strategies as well, not just purely looking at the average of the data over the last so many years.
Yeah, we're going to spend the last 5-7 minutes on that, because there's another paper you cited, and from our friends over at AQR. I mean, you touch on regimes, and I think that this is super important, right? And we all know that maybe the last 20 years has been a little bit, because that's what we kind of remember, and I think we all know that they've been a little bit unusual for many reasons. And also, so I'm just thinking at the moment, when you just think of how much performance of equity markets are driven by, as you mentioned, the Magnificent Seven, and how much money goes into those stocks or flows just purely from products being created to mirror, an index where probably you can synthetically design them, where you put, most of the flows into the Magnificent Seven, because maybe you don't want to buy all 500 stocks in the S&P 500, for example. And then on top of that, you have massive concentration of capital, because managers like Vanguard and BlackRock, they own huge amount of these Magnificent Seven stocks. I think that Vanguard owns 8% of Apple or something like that, which is crazy. And these products are not price sensitive. They're just driven by flows. So what happens when the inflows we've seen for years and years, maybe at some point turns to outflows? Who knows? And of course, within the Magnificent Seven, and other big companies, we've also been through a regime where buybacks has been the big thing. I think Apple is buying back 80 billion of stocks every year. So, it's just a crazy time in many respects. So anyways, we'll see. But actually, that is quite of a nice lead-in to the AQR paper, where they kind of ask whether the next decade will be like the last one. So it kind of plays a little bit on that. So I'll let you briefly talk about.
I won't spend too much time, but it's basically asking the question, what's the likelihood of the returns that we've seen in US equities over the last decade or so being repeated? And, we often say, it's going to be hard for equities to do as well. But what they actually do is decompose the returns into a number of different factors or the different constituents that drive equity returns, which are, the dividend yields, the real earnings growth, whether there's any multiple expansion, and then the kind of the risk-free rate. And basically, they go through it. I won't go through it all in detail, but they go through it all bit by bit. And over the period 2013 to 2023, obviously you did have real earnings growth as being an important driver, but you also had significant multiple expansion. So, can those multiples expand by as much going forward? You'd have to say that would be very difficult. And then it's a question of, what about the other constituents? the conclusion is the last 10 years were unusually favorable. And when you look at the building blocks, it's going to be hard to repeat such a positive performance. Now, that's not to say they're saying stocks are going to drop by 50% or anything. They're just saying that expect more muted returns if once you do a fundamental decomposition of the fundamental drivers of equity returns, it points to more muted returns over the next 10 years. But that is even without any potential regime change, as we've been talking about. That's within the current kind of regime.
But I think they're the ones who also go on then to ask this question about whether you really need diversifiers in the 60-40 portfolio and whether CTAs are essentially just vol dampeners. Or maybe that's another...
That's probably possibly, as we're up in time, I think that might be a topic we'll have to come back to on another day, I think, too. Too much to say on that, maybe.
Okay, fair enough. Can you give us a little bit of a teaser in terms of that?
I suppose to tee it up is I had a conversation in the Allocator series with Joe Prendergast at Goodbody, the most recent one. They're a wealth management firm here in Dublin. And he was making a point, in terms of how they run portfolios, it's broadly 50% growth assets, 50% kind of safe, diversifying assets. And so it's kind of a derivative of the 60-40 portfolio. He was making a point that if you look at it on a rolling 5-year basis, that portfolio does pretty well. It does very well historically at kind of always having an above zero return. So that a lot of the time, us in the managed futures industry, I'll include all of us here as part of that. When we're making a case, often we'll say, oh, well, it'll improve your Sharpe ratio. And then the question is, well, is that relevant for a private investor? As you say, you can't eat a Sharpe ratio. It doesn't mean a smoother ride, but, just because something dampens vol, is that enough? Equally, we often point to very long data series when we, point to the benefit of managed futures. Say, look, over the last 24 years, it did X for your portfolio. And people might say, well, my time horizon is more like 5 to 10 years. So how relevant is that? So what I was going to do, and maybe we'll do it again, is can you still make the case for these strategies, which I think you can, even just ignoring the fact that you can get Sharpe improvement and vol reduction, just purely from the lens of the outcomes on a 5-year basis. Because I think that's the challenge that you get. Certainly when I speak to some investors, they'll say, oh, do we need these liquid alts anymore? Your bond yields have gone up. They're just there to, what are they there for? So I do think there is that perception. It's, on the one extreme, you have people on this podcast who'll say trend following plus nothing. But a lot of the investors I speak to are more if you're trying to incrementally get them to allocate to these strategies. And these are the kind of the challenges and the pushback that I often hear.
Yeah, no, that's fair. We'll definitely pick this up. Just remind me, Alan, next time we speak, because, of course, we do want to certainly dig into the whole point about what it really means to diversify into non-correlated strategies and what that does to the compound rate of return, which may smooth the Sharpe, but it does a lot of other things, which I think you and I can agree on. All right, good stuff. Well, before we pack our bags and head for Miami, Alan, let me just say that if you enjoy these conversations, then please go to your favorite podcast platform and leave a rating and review. We always need them, and we always appreciate them, and we always read them. And of course, if you have a question for any of us, you can email it to info@toptradersunplugged.com, and I will get it to the appropriate person, and we'll bring it up on the show. And finally, next week, I will be recording from Miami with Mark. Probably not in person, but anyways. So if you have any questions for Mark, then do send them over, and I will do my very best, even if I'm on the road, to make it happen. From Alan and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes.
It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.